It feels like silver is being priced in two different realities at the same time. On your screen, you see one number. In the physical market, people are paying something else. And the headline, spreading fast right now, is this: silver is $100 in China. If that's true, it's not just a silver story, it's a power story. It means the metal is flowing toward whoever will pay the most, and the West could be losing control of the supply. But here's the problem with viral claims. Most of them are half true in a way that tricks you. Because when someone says $100 silver, they might be talking about retail street prices, taxes, premiums, or a shortage at one specific dealer. That doesn't automatically mean the entire world has repriced silver. So today, we're doing this the right way. No hype, no rumors, no emotional bait, just mechanics. How could silver trade near $100 in one region while the West shows a much lower official price? What does it actually mean when people say Western vaults are being drained? And what would we need to see for this to become a real global break in the system? Because in every empire, in every era, the same warning sign shows up right before a reset. The official price separates from reality. And once that happens, the rest is just timing. Let's start with the most important idea in this entire video. Silver doesn't have one price, it has a hierarchy of prices. At the top is the paper price, the number you see on the charts. It's fast, liquid, global, and it controls the narrative. Below that is institutional physical pricing, where big buyers source actual bars. Then you have dealer pricing, which includes premiums and supply conditions. And finally, you have what normal people pay when the metal becomes hard to get. In calm markets, those prices move together, and the gaps are small. In stressed markets, they don't. They turn into a staircase. So when you see reports of $100 in China, your first question shouldn't be, is it true? Your first question should be, which layer of the price ladder is moving? If it's retail, that can spike fast and be temporary. If it's local wholesale, that's more serious. And if the price gap starts showing up at scale and bulk physical flows, then we're looking at something much bigger. Now let's talk about the East pull theory, the idea that Western metal is being drained to feed demand in Asia. This is not a new pattern, it's historical. When a region becomes the world's manufacturing engine, it pulls raw materials like gravity. And silver isn't just a shiny metal people buy for safety, it's industrial. It's used in electronics, medical tech, and a major one that people often forget: solar. If industrial demand is strong and investment demand stays alive, the physical market tightens. And when physical tightens, the price doesn't rise evenly everywhere. It rises where the stress is worst. Metal is loyal to price. It flows to the highest bidder. It flows to the market that can't afford to wait. So if China is paying a high enough premium, traders route supply there. Refineries shift output. Logistics follow the margins. And the West slowly feels it in the one place that matters most: inventory. But we need to be careful with the word vaults. When people say Western vaults, they picture a giant room full of bars and assume it's either full or empty. Real systems don't work like that. What matters is not how much metal exists in a building. What matters is how much is actually available. A vault can look full on paper while the deliverable supply is tight because a lot of that metal is already owned, allocated, or simply not for sale. That's why the market uses different categories for inventory. Some metal meets standards, but isn't committed to delivery. Some is specifically registered and ready for delivery. In a stressed market, the difference between those categories becomes everything. Because a system can survive headlines, it can survive memes, it can survive YouTube panic. But it cannot survive one thing: a lot of people asking for the same physical metal at the same time. That is the point where the paper price gets tested. And this is where most people misunderstand what the paper price really is. Paper pricing exists because most participants are trading exposure, not metal. It's a reference number that makes hedging possible. It's how industry plans. It's how dealers set their baseline. And it works as long as physical delivery is trusted. But when the physical market tightens, the first sign isn't always the chart. The first sign is premiums, then delivery times, then availability of large bars. Then a phrase starts appearing in quiet corners of the market: can't deliver. If the system can't deliver, it doesn't always admit failure. Sometimes it offers alternatives: cash settlement, delayed delivery, substitutions, anything that avoids the one thing that would expose the real weakness. A real shortage isn't when people complain on social media. A real shortage is when institutions quietly compete for supply and the market stops behaving normally. So why would China price silver differently? Because local markets have local realities. Import friction matters. If supply is constrained by rules, paperwork, quotas, or bottlenecks, local prices rise faster. Industrial buyers matter. If factories need metal on schedule, they don't care about your chart. They care about delivery. Bar formats matter. Not all silver is equally usable for every buyer. Refining and fabrication create choke points, and currency conditions matter. Local risk premiums can separate local pricing from Western screens. So yes, it is possible for China to show a much higher real-world price while the West stays calm on paper. The question is whether that gap is a local retail spike or a structural physical dislocation. Here is how the draining mechanism would actually happen if this story is real. First, local prices in the East rise, then supply starts flowing toward that demand. Refineries allocate more output into that direction. Traders arbitrage the gap. And Western inventories begin to trend lower, not in a dramatic crash, but in a steady thinning. That thinning is what breaks systems. Because it's quiet, the public doesn't see it. And by the time it becomes a headline, the metal is already gone. So now we need to address the big number. Is $100 silver realistic? It depends on what you mean. Retail can absolutely hit extreme numbers in pockets of scarcity. Local markets can show massive premiums when supply is constrained, but a true global repricing is different. For silver to globally reprice, you would expect multiple signals at the same time. Physical premiums staying elevated across regions, not just one market. Large bars becoming difficult to source at scale. Delivery stress becoming a repeated theme rather than a one-off story. Inventory trends declining over weeks, not just one day. And the overall narrative shifting from investment to supply failure. So the smart move is not to worship the $100 headline. The smart move is to watch the gap, because the gap is the message. When the official price separates from reality, that's the warning sign empires have ignored for centuries. Now let's talk about what you should watch next if you want to track this without being played. Watch physical premiums, not just spot. Watch dealer availability and delivery times. Watch large bar supply signals. Watch persistent price gaps between regions. Watch inventory trends over multiple weeks. Watch industrial demand narratives, especially solar and electronics. If those signals line up, then $100 in China stops being a meme. It becomes a warning that the paper price is losing authority. And that's the real story. Empires don't collapse from one headline. They collapse when reality and the official story diverge, and the system can no longer force people to believe the numbers. Silver is one metal. But the mechanism behind this story is the same mechanism that has reshaped power throughout history. If you want more documentaries like this, subscribe to Money and Empires, because the next time the price splits, it won't feel like a rumor. It will feel like the start of something bigger.